Welcome back to the second part of Part 1, Chapter 3. We will be discussing a special type of deferral adjusting entry called depreciation first, and then we will move on to deferred revenue and accrued expenses and revenue. A special category of prepaid expenses are called plant assets, and they refer to long-term, tangible, meaning you can touch them, assets used to produce and sell products and services. Plant assets are expected to provide benefits for more than 1 year. Good examples of plant assets are buildings, machines, vehicles, and fixtures. As is true with all assets, the accounting system attempts to match the use of a long-lived asset to the revenue generated by that asset. It wouldn't make sense to expense a $300,000 piece of equipment on the day we bought it. That would really throw our net income out of whack, wouldn't it? Depreciation, then, is what we call the process of allocating the cost of a plant asset to the income statement in a logical fashion. At this point in the accounting process, I'd like to introduce you to a depreciation method known as straight-line depreciation. Straight-line depreciation is the most popular method used by companies. They determine the amount of annual depreciation by taking the cost of the plant asset, subtracting the estimated salvage value, and dividing that amount by the useful life of the asset. We will cover this idea in great detail in Chapter 8 later in the semester. For now, let's look at depreciation expense more closely. Computing depreciation involves taking into account estimates of the asset's useful life and scrap value. For now, be sure to read pages 104 to 106 about plant assets and the important definitions in the formula for straight-line depreciation. Let's see how depreciation expense is calculated, recorded, and reported. Assume Fast Forward purchased equipment on December 1st for $26,000. It is estimated a useful life of 60 months. The equipment is expected to be worth about $8,000 at the end of 5 years. The company purchased the equipment on December 1st, but now it is December 31st. We will depreciate the net cost of $18,000, that would be cost minus salvage, over the equipment's useful life of 60 months. Because Fast Forward expects the equipment to be worth $8,000 when the 5 years are over, only $18,000 of the cost needs to be spread over the next 60 months. With that in mind, how would you calculate the monthly depreciation amount? Did you come up with $300 a month? On December 31st, 2016, then, we will debit or increase depreciation expense for $300 and credit a brand new account called Accumulated Depreciation - Equipment. Accumulated depreciation is a contra asset account. Contra means opposite. This is the first time we have seen a contra account, but believe me, it's not the last. A contra account means that the amount in the account reduces the related asset account. So think of the asset account and the contra asset account as sitting right next to each other on the general ledger and on the balance sheet. Both of the accounts are asset accounts, but one has a debit balance and the other reduces it with a credit balance. They're joined hand in hand. In our case, accumulated depreciation will reduce the asset account called equipment. Because a contra asset accumulated depreciation is a new type of account, we will look at the treatment of the contra and the related asset account on the balance sheet. But first, can you write out the journal entry to record depreciation? Here's the adjusting journal entry to record depreciation expense. You can also see the balance in the equipment account. The depreciation expense account will appear on the income statement for the year ended December 31st, 2013. The accumulated depreciation account will be subtracted from the value of the equipment account on the balance sheet. As mentioned on the prior slide, the contra account accumulated depreciation will be shown as a reduction in the cost of the asset equipment. As you can see, the contra account allows balance sheet readers to know both the full cost of the asset, that would be $26,000, and the total depreciation taken to date, at this point $900. Because plant assets are such a large percentage of many companies' assets, investors and lenders are interested in how soon it will be before the company has to replace the assets. By showing both the cost and the accumulated depreciation amounts, users of the financial statements have a pretty good idea how old these plant assets are. The cost of a plant asset less accumulated depreciation is known as book value. So the asset, equipment, will be shown on the balance sheet at its net amount or book value. In the partial balance sheet shown on this slide, 3 months of depreciation have been taken on the equipment for a total of 3 times $300 or $900. The equipment account is being reported at $25,100 net, which is a cost that has not yet been depreciated. Because the contra account appears on the balance sheet, it will not be closed at the end of the period. This is important foreshadowing for you. It will be carried forward to 2016 and used to accumulate more depreciation related to equipment. Now let's move on to the second category of adjusting journal entries called deferred revenues. The term unearned revenues refers to cash received in advance of providing products and services. Unearned revenues, also called deferred revenues, are liabilities. We talked about unearned revenues first in Chapter 2 and gave the example of season tickets for the Sacramento Kings. When accounting for deferred revenues, we are faced with a transaction where cash is received in advance of providing a product or service. In other words, we have received the cash but have done nothing to earn it. This is very, very common. Think about the purchase of airline tickets, or catering services for a wedding, or putting a deposit on a room at a bed and breakfast. In all cases, the customer gives the business payment up front. At the time the company receives the cash, it debits cash and credits the unearned revenue account. Once the company performs the service, it no longer owes the customer for it. At the time the service is performed, we debit or reduce the liability account and credit or increase the revenue account. On October 1st, 2013, Ox University sold 1,000 season tickets to its 20 home games for $100 each. Basketball games will start later in the month. What entry does Ox University make on October 1st? On the date of sale, the university recorded a debit or an increase to the cash account and a credit or an increase to a liability account called unearned ticket revenue. We know the use of the word revenue may be a little confusing for now, but remember that the key word here is unearned. The university has done nothing to earn revenue from the sale of the tickets. So we will post the entry to the ledger account unearned revenue. Remember, unearned revenue is a liability account and will remain a liability until the university provides basketball games for the season ticket holders. Now let's look at the adjusting entry the university will make on December 31st, 2013, the end of its accounting period. As of December 31st, 2013, the university has played 10 games and compiled a record of 2 wins and 8 losses. Let's make the adjusting entry. The adjusting journal entry would be to debit or decrease the liability account unearned revenue and credit or increase the revenue account basketball revenue for $50,000. This is exactly half the revenue. They've played half the games. The number of games lost or won doesn't matter except to the fans. Let's look at the balances in the ledger account. The unearned revenue account has a credit balance of $50,000. This money will be recognized as more home games are played. The basketball revenue account has a credit balance of $50,000. The revenue account will appear on the income statement and be closed at the end of the accounting period. The liability account unearned revenue will appear on the balance sheet on December 31st as a liability. Now let's change the subject and look at adjustments for accrued expenses. Accrued expenses then are pretty easy to understand. In short, accrued expenses are handled much like accounts payable. When the company receives goods or services but doesn't pay for them immediately in cash, nothing has been recorded on the books to reflect the transaction. However, accrued expenses must be reported on the income statement of the period when incurred. So, at the end of each month, we need to evaluate whether we've received anything for which we haven't paid by the end of the month. And to correct our accounts, we must make an adjusting entry to accrue or increase an expense and a liability. For all accrued expense adjusting entries, we debit or increase an expense account, or it could be an asset account, and we credit or increase a liability account. Once the liability is paid, we handle it like we do paying off an accounts payable. We debit the liability and we credit cash. In your personal life, for example, when you use your credit card or your cell phone, often you do not record the transaction until you pay your monthly invoice, even though you have incurred the cost. Salaries payable and interest payables are examples of accrued expenses for businesses. Be sure to review your textbook on pages 109 to 110 to find out how to record and handle accrued expenses. Accrued revenues are also easy to understand because they behave like accounts receivable. The adjusting entry to accrue revenues is needed because many firms have delivered a product or provided a service but have not recorded the revenue in the current period. For example, assume a lawyer provides legal services but has not yet been paid by her client. The lawyer has earned the revenue but has not recorded it. She will need to make an adjusting entry to fix her company's books and recognize revenue at the end of the period. The adjusting entries to record accrued revenue will always debit or increase an asset account, normally a receivable such as fees receivable or interest receivable, and credit or increase a related revenue account. Once payment is received from the customer, the company will debit cash and credit the asset account. Please review your textbook on pages 111 and 112 to learn how to account for accrued revenue. There is certainly a lot of information on this screen, but it is a good summary of deferrals and accruals. It is also in your textbook, I believe on page 113. In the next section, we will review the adjusted trial balance and closing entries.